Hello, my name is Veronika Koroleva. I'm a partner at a challenger law firm, gunnercooke. Just a bit of introduction. I'm a trade and commodity finance lawyer. I've been doing it for almost 20 years. gunnercooke is my latest home. As a challenger law firm, we use a business model which is different from that of a traditional law firm, which is essentially a time-based model. So as a rule, our clients have certainty that they will always that the advice will always be given to them by experts in their field. The subject of my session today is a 10 in 20. So it's 10 legal issues, or 10 stories rather, that had effect on legal background and legal landscape, or will have effect on legal background and legal landscape for months or years to come. My selection of the stories for the session is entirely subjective, so I take full responsibility. So if anybody wanted to suggest more or think that I'm wrong in selecting those, please email me later with any questions or comments you may have. Or I'm also going to be available in the speakers lounge at the TXF conference after the session, or you can contact me through the TXF event platform. Due to the time we have for the session, this is going to be focusing on the highlights rather than trying to attempt to go into any of the stories in any depth. So without further ado, we're going to start with the disaster movie scenario that came to life in 2020. And affected all of us and our businesses differently. It disrupted our normal way of life, and it had an effect on everything from supply chains to the number of times we wash our hands as we go about our day. So with the second wave of the pandemic becoming the reality now in many countries, some of the things I'm going to talk about that have happened early in the year are likely to maybe start happening again as we're entering the second wave. So we'll see. So things that have been happening with having immediate effect on the industry were restrictions on movement of people and goods. That, apart from the sort of obvious consequences of that, made it more difficult for lenders to, for example, do their due diligence, on-site due diligence, or do the monitoring of the performance of the transactions they were financing. The execution and delivery of documents was made more difficult, again, with the restrictions of where we could go and how we could do business. With remote working becoming the norm for quite big chunk of people, certainly for a lot of financial institutions, issues related to data protection and compliance with people, and a huge number of people working remotely became very important. Now, as lawyers advising clients, I've seen huge amount of queries and disputes under commercial contracts. And I can honestly say I don't think I've ever seen anybody reading force majeure clauses as much as they were read earlier this year, when a lot of parties found themselves in the situation where they just could not perform, or the counterparty was not performing under the contract. Now, some of these disputes have been resolved peacefully, or people finding their way, or parties finding their way to agree something that would work for both of them. Someone will undoubtedly find their way into the court system or the arbitration. So eventually we will see the outcomes of, once they found it, they go through their way through the court system, we will see what came out of that. So there'll be a certain amount of case law coming out of this. That would take some time. In terms of future for the force majeure clauses, that they used to be one of those just the sort of bits at the end of the contract that nobody paid too much attention to. I think that's going to change, certainly for the nearest few years, and people are going to devote much more time to carefully negotiating what constitutes force majeure and what remedies will be available to parties in the event of a force majeure or similar circumstances. The payment obligations under finance documents were looked at closely. For obviously, again, we've seen increased number of inquiries from borrowers who thought they may not be able to perform, i.e. pay under the financings, and the queries were around whether or not that, the pandemic could constitute a default force majeure under those and somehow provide an excuse, to which generally the answer is no. There's been an increased number of work on amendments and waivers on various existing finance documents to just fit the realities of the life around us into the documentation, which was clearly negotiated and prepared without that in mind. It's the inability to perform contractual obligations just due to, again, the change of the, massive change of life around us affected ownership-based structures, including Islamic finance, ownership-based structures, because that had effect on, possibly the need to extend the ownership periods, inability to deliver the goods back to the financiers. There's a huge amount of issues and queries and work had to be done around trade instruments where, again, due to what was going on around them, banks had to deal with scenarios where either they were presented with demands under the documents that were issued in relation to a transaction that was no longer performing, or they had to deal with issues with delivery of original documents that, again, was made impossible or difficult under the pandemic scenario, or in some rare occasions they had to deal with issues where their branches had to be closed due to quarantine and the inability to conduct business in the normal way. The pandemic had an effect on various receivables finance structures, because for most of this, as everybody knows, lenders or financiers tend to purchase the debts on the basis that the underlying transaction, the sale of goods or services, has already been performed. So there were lots of issues around whether the non-payment for the goods and services delivered by the underlying debtors was due to pure payment defaults or pure credit risk, so possibility for the financier to pick up the tab, or was there a genuine dispute, i.e. potentially a breach of a representation by the seller, which possibly means that there is a recourse event back on the seller. So there's a huge amount of, work done on all of these things. Now, that in turn gave rise to huge amount of legislation, primary and secondary, adopted in the UK and around the world. So the title of COVID-related lawmaking is a rather awkward name for a lot of legislation that was brought forward because of the pandemic. So there was a huge number of new laws adopted by governments around the world to support individuals, the people, and businesses, and that had to do, around employment and furlough and payments to employees, around landlord and tenant rules, and say restrictions on the ability of the landlord to evict the tenants, both, again, individuals and businesses. Some of that would have depending on which business you're in or which business your borrowers are in, that might have relevance to what you do. There's also a huge number of laws brought into a rather huge number of support for businesses brought in by various governments. This tended to be in the form of loans, and the issues around that we either have already seen or are going to see playing out later is a lot of this was brought in by virtue of emergency legislation. So obviously, emergency legislation by definition is not legislation that's thought through in great amount of detail. So equally, there's a huge pressure on both governments and the banks who are administering the loans to do it as quickly as possible. They could not do it quickly enough. So now when the public sentiment slightly changing from well, it used to be early in the years to, why is it taking so long, to somewhat, why was it allowed, why was so much support was allowed to be given to businesses that are not going to be viable, or why was it allowed for so much fraud around obtaining those loans to happen. Now, it will take time for everyone to see how, the sort of magnitude, the scale of those issues, but potentially they could have an effect on the financial health of the banks they were administering, through which these schemes were administered, even though quite a lot of these loans were government backed. The other thing that possibly wasn't thought through by all the borrowers or all the parties that were getting the state support is how the government loans will sit with the existing financing, or how the terms of the government loans, which were largely non-negotiable, they were sort of take it or leave it, are going to fit into the long-term future of the business. So, for example, one of the UK government scheme, Future Fund, is a convertible loan. So potentially in about 3 years' time, the businesses who've taken part in that scheme are going to have UK government as a major shareholder, which, again, query how many of them have thought through all the implications of that. Generally speaking, there's the regulators, including the FCA, started taking quite much more active role during the pandemic. So, for example, just to give like an example, FCA was launched, and it's now been through the court, have started the case about the business interruption insurance, which is sort of the industry-wide implications. So it wasn't suing specific insurer, it was looking generally at how the insurance industry was responding to a huge number of business interruption claims. Again, depending, whether that case goes to appeal and how the market, the insurance market responds to that, the increased number of business interruption claims under insurance policies will have an effect on the general health of the insurance market, which might reduce the availability of other insurance product that the trade and commodity finance industry relies on. They were also, in response again to the changed reality of life, governments brought through various rules relaxing certain or changing certain corporate governance requirements. So, for example, there were various protections provided for directors in the event of wrongful trading for the companies that continue to trade during the pandemic. Certain filing deadlines, including filing for charges, was extended. Companies were allowed to conduct virtual shareholders meetings. That is something that, obviously for the companies affected, that's something they need to be aware of. But for lenders of those companies, that's something that they need to bear in mind, that there's certain rules have changed, or certain leeway was allowed to companies. There were also amendments to insolvency rules. So various forms of moratorium were on certain debt or certain insolvency proceedings was allowed to preserve the companies and stop them from going insolvent en masse. So in the UK, the relevant legislation is Corporate Insolvency and Governance Act. So there are similar or equivalent acts adopted by governments in a lot of other countries. So again, while doing business or looking at what you can do, what remedies you can or can no longer use with your counterparties, be it commercial or finance transactions, that's something that certainly needs to be looked at. So amongst the measures that the Act introduced are suspension of possibility of suspension of certain debt obligations, the suspension of termination clauses in supply contracts for a business, and, as I mentioned before, the protection for the directors in certain cases. The discussion about insolvency rules brings us nicely to 3, defaults and restructuring. Now, the fact that the whole industries have been affected by the pandemic, and some of them still exist in this suspense that, and with the second wave coming, it's entirely unclear how it's all going to pan out in the end for, again, quite a lot of industries and businesses. We are going to see eventually significant restructurings. It will eventually sort of feed through, and quite a lot of that is going to be done on the so-called amended pretend basis by amending the existing facility documentation. Some will inevitably be fairly large scale, and if post-2008 experience is anything to go by, we will see specific legislation brought in either to deal with rescues or insolvencies, but dealing with financial distress either in specific industries or in make it something sort of specific to consequences of the pandemic. But my personal prediction is there will definitely be legislation around rescue or restructuring of specific industries. So that's, together with the change to insolvency rules that's already happened, this is a space to watch. Now, another major consequence of the pandemic was the drive to digitalize everything that can possibly be digitalized. Now, that's not a new trend. That's been very speedy and moving forward in the past few years, but all the trends that were there for the last few years just accelerated massively due to the pandemic. So there's a drive to make two points to that. There's a drive to basically make sure institutions and businesses can cope with the realities of life, so digitalize everything just to make sure we can do it. But also there's a huge amount of initiatives and work done around the world to remove any legal obstacles that either require people to be present to do certain things, for example, sign documents in person or things like that, or requirements about delivery of original paper documents, such as the case, for example, with Bills of Exchange Act. So there's a huge amount of initiatives and there's a huge amount of work done to remove that. So just to give you examples, that just refer to there's work being done in the UK to remove the requirement for the legal requirements for delivery of original trade documents. So I can refer you to the ICC recommendations on that. It's also worth mentioning that International Trade and Forfeiting Association had a number of fintech initiatives, including around trade instruments and negotiable instruments. There's also a huge drive to digitalize compliance, which raises its own issues, and again, as to how much risk are institutions willing to take on once you move from in person on at the one end of the spectrum to completely digital and completely done online the other end of the spectrum, and also a huge amount of work and initiatives and new products around digitalizing processes in the industry. We come to this known unknowns and unknown unknowns. Because it's being done at such a speed now, there will definitely be consequences of that we may not foresee at the moment, just because that's, again, life is never entirely foreseeable. So that is certainly a space to watch in terms of what else can happen and what other unknown consequences, both legal and just practical for the life around us, we're going to see. So next one is fraud. So the general understanding of the industry that trade and commodity finance is relatively low risk and instances of fraud are relatively rare has been dealt a major blow with several major commodity finance frauds coming to life early this year. Now, as with other things I mentioned before, that will produce a huge amount of case law that we're going to see in due course. That's like the immediate, for the lawyer in me, that's the sort of immediate, the immediate consequence. But it changed the landscape. Some banks exited the market. Other, alternative financiers have perhaps replaced them or use the chance to replace them, to take their market share. The requirements of the banks, of other financiers, have changed and somewhat become tighter on certain controls. Different structures are going to be used. It just generally been quite a, major factor in the modern market. Now, in response to that, so what have we seen? So we've seen wider use of technology to try and reduce the risk of double financing. So, for example, there's a Singapore Registry of Trade Finance deals that the banks that are participating in that thinking it is going to help them see what's going on, with the borrowers they finance, and therefore reduce the risk of double and triple financing. I'm sure there'll be more initiatives around that to see how technology can help. I predict that they're going to be wider use of collateral management and similar means of risk mitigation. And I would like to see some industry-wide standards for collateral management to be introduced or agreed by the industry to assist with that. I would also like to see, and I think that is going to happen, to see a wider use of intercreditor arrangements in the scenario where there's several lenders to the same, say, commodity trader, to ensure that all the lenders have the same information about what's going on with the trading business, and also they can be sure that they are not all financing the same thing. So again, the risk of double, triple financing to be reduced. It was hard to Brexit's the next one. So it was hard to imagine at the beginning of this year as to what could happen to take the story that's been dominating, well, certainly the press, but also our lives for a few years now, away from us, and to sort of make it less of a story. But pandemic managed to do that. Nevertheless, Brexit has happened. The UK has exited the European Union. The terms on which the UK is going to be dealing with the countries in the European Union are still being negotiated. So one, in my view, is one of the worst consequences of the decision by the referendum in the UK to leave the EU is this huge period of uncertainty that's going to last years and years and years. We are still in the middle of it. We still don't know how exactly the post-Brexit world is going to look for us. So that's still continuing. I mean, there are obviously going to be huge consequences for financial services and regulations applicable to financial services. There will be effect on free movement of people and goods. Again, because the exact terms have not been agreed, we don't know what they're going to be. So that's something to watch unfolding for years and years to come. So keeping to the theme of politics affecting trade wars, and just a general state of the world, from the US election to, I don't know, whatever else is happening right now, affecting international trade. So the trend of wider use of everything from, trade sanctions, from sanctions to some sort of trade restrictions is continuing. That increases political risk for the transactions that have been put out there. The latest trend with sanctions seems to be imposing targeted sanctions on named individuals in specific countries. It's probably going to continue for a while at least. So any sort of increase in sanctions, and well, first of all, means that there's a potential for mismatch between sanctions that's imposed by different countries. That creates difficulties and requires a lot of compliance and legal time to work their way through it. And generally, any increase in sanctions increases the compliance burden, which in turn either leads to more documentation that needs to be produced or to basically unavailability of financing, so the increase of the trade gap. So not great. Now we're moving to almost normal. So this is something that's an echo of the previous crisis, the transitioning away from LIBOR as a reference rate for finance transactions. So just to recap, for decades, LIBOR was used as a reference rate for transactions denominated in sterling, dollars, euro, francs, and Japanese yen. It's most likely going to disappear next year. So there's a huge amount of work done by the regulators, the industry associations, and the financial institutions themselves to work through. I mean, there's the regulators have suggested the replacement rates they're going to be used instead of, or their preferred replacement rates to be used instead of LIBOR. So there's a huge amount of work being done around how they're going to work, which rates are relevant and appropriate for different products, which markets are going to be used, you're going to be using which rates, which products are going to be affected, and how, and most importantly, how it's going to be affecting existing facilities and future finance facilities. It's a huge subject. It's just one of those that probably require its own session to go through. So we're moving on to the next one. This is definitely a throwback to almost normal. So this is the supply chain finance and the developments in supply chain finance in the last few years. That's sort of still there, still happening, but with everything else that's going on in the world sort of somewhat being overshadowed right now. So the supply chain finance industry was affected by the collapse and restructuring of Abengoa and Carillion. So what transpired, again, this is a short recap. So what transpired, both of these companies were huge users of supply chain finance programs. These weren't reflected expressly in their financial statements. So post their collapse, questions were raised as to whether better rules around disclosure of participation of large buyers in supply chain finance programs better rules are needed. And there's certain push from certain parties to make this participation and debt under these programs and to be reflected as bank debt in the financial statements. Now that's pretty much an existential threat to this as a product. So hopefully, but it did elicit quite a big response from the industry. But the need is still there. The need to deal with it is still there. It's not something that can be solved by the direct participants in the industry, so neither by buyers nor by financiers. So that's something, the financial standards and the requirements is something that has to be worked through by the industry, maybe industry trade bodies, together with International Accounting Standards Board and local accounting standard boards. So that process is happening. Probably is going to take a long time, but we'll see. And another thing that came up not so long ago and was talked a lot around supply chain finance as a product was the allegation that the sort of whole purpose of it is to extend payment terms on suppliers and to abuse small suppliers who participate in these programs. That sort of somewhat ignores the idea that for most of these suppliers, this is the cheapest way of accessing any financing that they could find. But, obviously it has to be balanced. And with the current trend around the world, around the markets around the world, for social conscience in the way businesses do their business, that's not going to be ignored. So the best the industry, in my view, could do is to deal with it by way of self-regulation, to somehow adopt good behavior standards around how far can you stretch the supply terms. If that's not going to happen, so somehow that's not going to be deemed sufficient, I think eventually we will see some regulations around it, or some sort of law, some sort of laws and rules around it. So again, let's see how that pans out. So that discussion about the business with conscience brings us to the last, number 10, ESG and the wide use of that, whatever that encompasses, in the way businesses do finance. The pandemic did not stop that. I mean, this is not a new trend, and again, that's been in existence in the last few years. And if anything, the pandemic has accelerated the demands for green recovery. So we are seeing, and we're going to see in the nearest future, the larger use of facilities for either for green purposes or sort of, the other side of it. There's already quite a few restrictions on what industries can be financed, or what industries rather the banks are willing to finance. There's a wider use of ESG criteria, by quite a lot of financial institutions. There's the different approaches that are discussed and are used by financial institutions. So one is around, we won't touch anything that does not comply with our strict requirements. And there's another alternative one is, yes, we will finance you, the business that at the moment does not really comply with a lot of our high standards, but the financing is conditional on you striving and achieving certain milestones as you improve on various things that at the moment, don't meet our standards. It's an interesting argument to be had as to what is the more productive one and what effect it will have on, emerging markets and availability of financing there generally, given that quite a lot of them still rely on what is considered to be dirty and not green industries, but that remains to be seen. Certainly the ESG criteria became quite high on the investors' requirements. There are already some regulations around it in different countries around the world. My prediction is there are going to be more, especially around environment. That seemed to be sort of the E part of the ESG, seems to be quite sort of big one. On the social governance side, the what's happening with the rest of the world and the Black Lives Matter movement, and sort of slightly earlier than the Me Too movement, it is finding its way there too. So I think we will see, again, once we sort of slightly out of the immediate dangers of the pandemic, we will see the wider engagement and the discussion around improving, gender balance in the industry, or in the industries that, lenders finance, or, the focus on generally on the sort of equality and diversity issues. If the industries or the businesses as a whole are not going to respond to that quickly, again, purely my prediction, but I think we will see a return to conversations about various quotas on employment, on financings, on things like that. And in conclusion, to sort of fit it in a slightly wider sort of social fabric, I think what the pandemic has brought forward is there's a discussion to be had by sort of wider industry, wider society, about the role of big lenders and big banks as institutions, because the reputation of banking industry as a whole has not quite recovered from the 2008, and it's quite an interesting time right now with the pandemic as to whether or not that could be improved or made worse, for example, by the response, to support the businesses in need. Or in the later stages, I say, we're going to see a wave of restructurings by how the lenders and financial industry generally are going to behave to deal with that. And one last point about the future of an industry, of our industry, is one of the long-term consequences that we're going to see is the effect of everyone working from home, and the effect it has, largely, well, as the statistic shows, on women and on junior professionals joining the industry who no longer have the benefit of learning, their craft face to face. So it's not going, it's not something that we're going to see the effect immediately and straight away, but it will affect the industry. And with all of these things, if the industry itself doesn't find a way to deal with it by self-governance or just by adopting certain practices, that I predict eventually the regulators will somehow step in, and there will be more laws and rules around that then everybody will have to comply with. That's that's a bit of my sort of purely predictions, not something I can legally or scientifically prove. So that concludes my top 10 of the 2020. As I said, please feel free to contact me either on this email or the phone numbers on screen, or in the TXF platform, or I will be available in the Speakers Lounge at the TXF conference for a while after the session. Thank you for your time. It's been a pleasure. Goodbye.
Well, thank you very much, Veronika, for bringing us up to speed with the top legal headlines from 2020. There was a lot to digest there, and if you have any questions for Veronika, then please do join her in the speaker lounge shortly. Otherwise, we'll be moving on to our next spotlight session, focusing on the topic of collateral management. I'll hand over to the moderator for the session, my colleague Charles Osborne, Senior Relationship Manager here at TXF. Thank you.